Let's talk about a financial fantasy, a world that sounds almost too good to be true, a world where borrowing money is completely free. But as you're about to see, this kind of dream can turn into a real nightmare pretty fast. We're going to unravel the zero interest trap.
No, really, just stop and think about that for a second. What if you could borrow, say, $1 million, or in our story today, 1 million leaves, and all you had to pay back was exactly 1 million? No interest, no extra fees. What would you do with all that free cash? And more importantly, what happens when everyone starts doing it? All right, so let's dive right in. Our first stop is what I'm calling the free lunch fantasy. Picture this, we're heading into a jungle version of the Roaring Twenties, where it seriously feels like the party is never ever going to end.
Okay, before we go any further, let's get on the same page. In our little fable, money is just leaves. And interest? Well, that's simply the cost of borrowing those leaves. It's the little extra you have to pay the bank for giving you a loan. It's the one rule that's supposed to keep the whole financial jungle in balance.
But what happens when someone breaks that rule? All of a sudden, the cost to borrow is zero. That 1 million leaf banana mansion you've been dreaming about? Guess what? There's no extra cost to finance it. Lamborghinis are cruising down the jungle streets. Every single monkey feels rich. It's basically paradise, right?
So you're probably wondering, why would this even happen? Is it just magic? Not at all. There is a very specific reason why the leaves become free, and it all starts when the economy is feeling, well, a little bit sad.
See, this isn't some accident. It's actually done on purpose. It's a deliberate government policy. When the economy is struggling, the central bank makes a huge move. They slash interest rates to the floor, making it unbelievably cheap to borrow money. The goal is pretty simple. Get everybody spending again and, jumpstart the whole system.
And you know what? At first, it works like an absolute charm. Factories start humming again, they rehire workers, all the monkeys, now armed with all this cheap credit, start buying everything in sight. We're talking washing machines, Model T cars, you name it. The whole buy now, pay later philosophy basically becomes the law of the land. The economy is officially booming.
But as we all know, there's really no such thing as a free lunch. Lurking behind this incredible boom, there is a hidden and very steep price tag. And this is where our little paradise really starts to show some cracks.
The first huge problem that rears its ugly head is inflation. Think about it. With borrowing being free, the jungle is suddenly flooded with leaves. And when every single monkey is flush with cash, what do the banana sellers do? They start charging more. Before you know it, the price of a single banana skyrockets from just one leaf to 100. All of a sudden, each one of your leaves is worth a whole lot less.
So now you've got this really tough choice. If you're a saver, your hard-earned leaves sitting in the bank are earning zero interest, which means because of inflation, they're losing value every single day. This basically forces you to become a speculator. You start pouring money into riskier things like stocks or crypto, not because you're a gambler, but because you have to, just to keep your savings from evaporating into thin.
And this is where things get really hairy. Welcome to the climax of our story, the rate hike nightmare. Because eventually the government looks around and realizes that 100-leaf bananas are just ridiculous. The party has to stop, and the bill is about to come due for everyone. The absolute terror hits anyone who took out an adjustable rate loan. You know, the ones that were super popular because they started out so cheap. But as this quote says, an adjustable rate is like riding an elevator. And to fight that insane inflation, the government is about to slam the button for the basement. And the crash, well, it doesn't just happen out of nowhere. It's a chain reaction, and it's devastatingly logical. First, the government hikes interest rates. Then, shocker, all those free loans suddenly have massive monthly payments. Third, the monkeys can't afford these new payments, so they start to default. And finally, the whole house of cards just collapses. The market crashes. Hard. And look, this isn't just some silly story about monkeys and leaves. This exact cycle has played out in real life. The Roaring Twenties, a whole era of easy credit, ended with Black Tuesday in 1929. And when that party stopped, the market plummeted 40% from its high, wiping out entire fortunes overnight.
Okay, so after all that doom and gloom, you're probably wondering, how do I avoid this? How can you protect your own leaves when this cycle inevitably shows up again? Let's go over a few survival strategies. The first bit of wisdom is simple: respect debt. I know this quote sounds super dramatic, but it's literally true. The word mortgage comes from Old French, and it means death pledge. So even when borrowing seems cheap,
you're making a very serious, very long-term commitment. Don't go crazy just because the bank is offering free leaves.
During a boom, it's so tempting to chase those high-risk F-tier assets. The penny stocks or the sketchy crypto projects that promise you'll get rich quick, but usually just collapse. A much more sustainable strategy? Focus on the S-tier, stable, long-term investments like index funds. They might not be as exciting, but they're built to last way beyond the bubble.
And that really brings us to the final question, the question for you. This cycle has happened before, and you can bet history tells us it is going to happen again. So when the next free lunch shows up promising easy money and endless growth, are you going to take the bait?